I'd like to thank everybody for joining me today. Today, I want to talk about repositioning assets for our client for a better tax result. And if you think about this, there's a lot of things out there on tax-free retirement. And part of it is, why do we do it? The other part is, how do we do it? And is it the best fit for our client? And when you ask a client, if they understand, really where taxes are, where they're going to go in the future, most clients will say they do want to create a more tax efficient plan for themselves. Now, when I start talking about this, one of the things I focus on is having clients understand what the money is that they're putting away. What is it going to be used for? And I'm visual, so I think about filling buckets. So if you think about this during your working years, you're going to be filling that bucket. That money is whether it's W-2 income, business income, whatever it is, that's money that's coming in, and for the most part is going to be taxable. Whether that's ordinary income, capital gains, a lot of that money is going to be taxable, and we have to make that as efficient as we can. Now, there's always the focus on retirement. What is the retirement going to be? And if you start looking at retirement and when that money is going to be used, how is it going to be used? Now start focusing how are we going to grow that efficiently, but also start thinking about the taxes. We talk about the seed and the harvest. On our retirement money, is it better to pay the tax now or later? Pay the tax on a little bit or pay tax on a lot later on. And we need to make sure we understand how that's fitting into their picture and why. And finally, what is that what if bucket? We always have to have that third bucket, and clients I don't think recognize this at times, that's money that's out there. We need it accessible when we need it, how we need it. There again, is that money growing tax-free, taxable? What is it going to be used? Now, when we look at this and a lot of our conversations, a lot of our clients get focused on the return and not the after-tax return, and we have to take that into account to really get the true picture. So if you think about the tax problem, look down the tracks and you see that tax problem coming. It's coming and it's going to create a problem. So as you start looking at the tax problem, what if you could switch the tracks? And now most people stay on the taxable plan. They're on the track that they're going to pay tax on every dollar going forward, whether that's coming in as income, whether it's payments coming out of a qualified plan. You start looking at that. If you're taxable pay as you go, that's going to eat into a lot of your income and a lot of your profits. Now most people know they can switch tracks to a tax deferred. I can delay the tax. I can put it away in my 401k or my IRA today. I get a tax deduction for putting that in. Now think about this. What is your true marginal tax rate on that money going into your 401k? What is it going into your IRA? I talk to a lot of clients, they're younger, they're paying, they have a mortgage, they have kids at home, and their effective tax rate is lower than they think it is. So maybe they're getting, a 10 to 12% tax on the money that they are, could have, put into the retirement account or could have saved. But when they take that out in retirement, what's that tax rate going to be way down the road? And that's what we're worried, have to be looking at is tax a little bit now so that we get tax-free later. So there's that third track, and there again, I don't think most clients know this track even exists. Can I get it over into never paying tax? Never taxable again. Now, a lot of clients understand Roth IRAs. When I talk to a lot of CPAs, they love Roth IRAs because pay the tax now, that money will never be taxed again. There again, the problem with Roth IRAs, there's limitations. And the limitation usually kicks in when a client has the money to put it in, they're capped out and can't get it in, so we have to be a little bit more creative. So stop and ask the question, do you want to reposition your assets? And are you at a point where you can reposition some of these assets to create that tax-free income? Now, the strategy I want to look at is repositioning to life insurance. Now, if we talked to some clients right now, they would have stopped the presentation because they've got life insurance. They don't need life insurance. They listen to people that talk about how expensive life insurance is. Now we understand life insurance is not a commodity, but it's a moldable tool. What are we trying to create? And with life insurance and tax-free, well, we can look at it. How do we design it? Do we design it for a minimum death benefit, non-modified endowment contract? So it mimics a Roth. We can put the money in, pay the tax today, put it into the life insurance, and have that in a tax-free environment going forward. But if you look at the benefits of the life insurance, it will, in a lot of ways, exceed what we can do with a Roth IRA because there's extra benefits that the Roth can't provide. So look at those assets. I mean, if you're talking to a client, their CD, savings account, investment accounts, what is it there that is going to create future tax problems? Or do we have assets that are underperforming? Now we can take those assets and we can pay premium direct to the life insurance policy, or if clients want to write one check and be done, we can use a premium deposit account. Sometimes we can use a single premium immediate annuity and spread those payments out so we can eliminate the modified endowment contract problem. But now we take that premium and we put it into a life insurance policy. Now, if we're trying to grow cash value and we want to get the most efficient cash growth, then we're going to pay that premium in as fast as we can within reason of the design of the policy. We want to grow that cash value. We want to be able to have that cash value product so that we have more what if available to us. Now, most people will stop and say, yeah, but if I buy a life insurance policy, it's just a death benefit. It's just a death benefit that somebody else gets to use after I'm gone. Well, the death benefit is an element, and that's something we don't want to overlook because that is a big piece of the puzzle for most of our clients' planning purposes. But let's look at what we can do with the policy during life. And I'll tell clients, this is what we're going to do for you short of you dying. So think about that cash value we're growing in there. Cash value allows you to use that money however you want, whenever you want. You don't have to wait till you're 59 and a half to take it out. You don't have to worry about the tax problems that creates is added to that money when you take it out. When you take that money out of this policy, you can do it tax-free over your lifetime. Now, you can take it as a withdrawal or you can take it as a loan. You don't have to decide now. You get to decide when it's time to use that what if money. And if you don't ever use it, it's going to pass on to your heirs income tax-free, and if we want, estate tax-free. Now, here's the other part of the planning that I think clients need to understand. With this life insurance policy, we can have long-term care benefits, whether it's a true long-term care rider or whether we use a chronic illness rider, and then some policies have critical illness riders. What I like about this, it adds more benefit to take care of our clients throughout their lifetime. And we can do it again, we're doing it in a tax-free nature. If they have a long-term care need, well, we're not worried about pulling money from an IRA that's going to have to, have taxes paid, and we may be net 40, 50, 60 cents on the dollar. If we need $1 out of this policy for long-term care and we have a long-term care rider, we get to take it out dollar for dollar, no tax. Chronic illness rider, we didn't pay for that rider up front, so we're going to have to pay some of that cost on the back end. There again, it's a what if the client needs it, it's there, use it, don't use it, it will be up to them at the time they need it. But think about how that works for our client. Now, don't overlook the death benefit. If I look at just purely Roth IRA versus life insurance, a Roth IRA, if you put $1 in and die the next day, you get $1. That's what passes on. If you put $1 into the life insurance with the leverage of the death benefit, your family's going to get something more. So think about that as you're repositioning all of this, how it will help you, how it will help your clients. And all of this can be done in a tax-free, nature inside the Internal Revenue Code. So as you think about your planning, that tax-free planning that your clients want to do, don't overlook life insurance as an excellent tool to be using. I appreciate everybody getting on, and we'll talk again next time. Thank you.